Good morning and welcome to another edition of the Weekly Market Note, the Halloween edition, as you might say. I'm Alex Varner, our head of research here at Main Management, alongside
James Maxwell, VP of Research.
let's get into the data that wasn't. As we continue navigating this ongoing government shutdown, the lack of kind of official data continues to just play out. I think we're, kind of waiting and seeing the private stuff, piecing together from other sources. You continue to get data points we'll show here and shortly. But kind of, overall, the Fed has mentioned they're not. I mean, I imagine they're probably a little frustrated with it, but they're using their own sources and resources. They got people back in the office to do the CPI report that was a week late, but they're kind of making do as best they can. But we get into that a little bit here. On the performance side for the week, it was pretty mixed. Sectors, four sectors higher, including the S&P, led by tech and consumer discretion. Real estate materials were down the most. On the broader indices, NASDAQ and S&P led the way, while Eurostoxx 50 and small caps were down the most. Year to date, 2025 through October 31st, staples is the only sector in the red, and then tech is head and shoulders above the rest, up nearly 30%. That's through Friday.
One thing I'll say on that, given the government shutdown, a lot of this government data is not coming out. I feel like there's been a larger focus on earnings, which you saw a lot of the big tech earnings last week. One of the reasons why they led the way, or the sector led the way, was those stronger than expected earnings, but just something to kind of keep an eye on.
Yeah, they're focusing on the data points they do get, and those are, since they're private companies, or I mean publicly traded, but like they're not government companies. So they're continuing to come out with their earnings, and the market is definitely placing a higher emphasis on those because they're kind of, taking what they can get, and that's what they're getting. On the recession dashboard, not a ton has changed here. Kind of overall middle to kind of a little bit stronger than middle. On the biggest news of the week and probably the month, given the way things have been going, is the FOMC rate cut. They cut by 25 basis points on Wednesday, as expected. That target rate is now at 3.75 to 4.0. There was a little bit of a surprise in the press conference, in that Powell was more hawkish than I think people had expected. He didn't mention the September dot plot, which implied a third cut in December, and he reiterated that policy is not on a preset course. I think he wanted to kind of recognize that there are dissenting opinions inside of the FOMC about a December cut, and he doesn't want markets to assume that a cut's a done deal. We kind of discussed this internally, but I think this is not quite as sensitive as it was in 2018 when the Fed kind of had a nasty surprise at the December meeting where it took things off a cliff. I don't think we're gearing up for that, but I think it is worth mentioning that history can rhyme. And so you might get an unexpected surprise at the December meeting. Right now, markets are pricing in a 65% chance of a cut in December. That's down from 90% a few days ago. So you can see markets are already resetting expectations, which is a good thing in that it opens them up and they are more able to adjust should they not get kind of the consensus view on the cut side.
I think personally, it feels like there's still going to be a cut as long as the kind of economic data that hopefully we'll eventually start getting again, but kind of the underlying economic trends continue where inflation doesn't have all that much pressure on the upside. You see other things like oil prices maybe helping bring that even lower, or less pressure on that, and then the labor market broadly just kind of being soft. Nothing kind of too hot there, whether it's kind of deteriorating or just stabilizing, but whatever you want to kind of describe it as, it's definitely not overheating. So that those two kind of things make it feel like they should continue to cut. It's not a given. I think that was the big takeaway, is like, yes, things can happen to make that not the case, but if things continue at the pace they have been, it feels like they.
Yeah, it's funny. I mean, anecdotally, I got a text from a friend on, what was it, Wednesday or Thursday, when they did the cut, or right after they cut, and he's like cutting into rising employment at all-time highs. Like, what can go wrong? And I was like, well, earnings are strong. Like the market's focusing on that. I think there's this continuing talk about a bubble. And I think there are certain areas that, and again, it also comes back to the definition of a bubble, where I think I saw somebody said if something doubles in price over a year, that's their definition of a bubble. So there are a lot of things that are in a bubble, especially gold, and you haven't heard gold being talked about in a bubble with people it going to 4, predictions going into 5 to 6 to 7. And so I think it's just worth saying, all right, if you're talking about a bubble, what is your definition, and also what area of the economy are you talking about? But we sent something around earlier today that was showing that on a valuation basis, things are still potentially in early innings. So again, it's kind of depends on what you're looking at, and from our standpoint, things are going to keep marching higher, assuming we get this continued earnings strength. And I think there's not a big reason for you to get kind of a pop and this big correction in a broad sense.
It's also the Fed's role is not to control asset prices, market bubbles, even GDP growth. That's kind of a byproduct of their policy, which is unemployment and inflation. So if inflation is lowering or coming down, there's disinflation, and the unemployment rate is going up or the labor market's weakening, like that's a very clear path for the Fed.
And kind of, on that, there were 2 dissenters. One wanted a 50 basis point cut. The other wanted no cut. Yields actually moved higher in the wake of the cut. The 10 years back around 4.1, which is where it was before we cut for the first time in September. 2 years back above 3.6%. Why? Again, the presser was a little bit more hawkish than expected. Differing views with more people maybe feeling we should pause. And then also, regardless of whether or not participants are on the pause or cut cycle, just the fact that they are not getting data makes them think they should pause. I think Powell even referenced in the press conference, he said, if you're driving a car in the fog and you can't see ahead of you, what do? You slow down. And that's basically you just slow the decision-making process. So maybe they wait a month, or maybe they wait until, they pause in December and just say, hey, look, we don't have enough data to make a decision. We've for years said we are data dependent. If we are data dependent and we don't have data, we shouldn't make a decision. And that would be pretty rational, I think, not out of the realm of possibility. And additionally, rates are up yields are up because, GDP is running higher than it is. I think the forecasts now are 2.5%, 3% kind of on average versus, a percent, maybe 1.5% in Q1 and Q2. And that's good. Economic growth, it can survive in higher rates and yields, work in higher growth environments. So that's a good thing in kind of to view where looking at the treasury markets moving higher on the yield side. Kind of switching away from the FOMC for a bit, the FHFA home price index, and this is for average single family homes with mortgages guaranteed by Fannie Mae and Freddie Mac. That was up 0.4%. So you can see on the bottom left there, that was a pretty solid jump month over month on the prices there, and it breaks the trend of 4 consecutive monthly declines. Index is just below its all-time high, but it's up 2.3% year over year, which is the smallest year over year increase since April of 2012. So those price increases are moderating. If you look at it, it's kind of staggering. We're up 54% from the pandemic, from 2020 to 2025, almost 2026. Prices have gone up 54%, and that's a huge reason that buyers have stayed on the sidelines. Even as mortgage rates have come down, the problem is prices are still so high that even as mortgages get more attractive on a relative basis, the dollar amount is just too high for a lot of people, and the affordability is an issue there. Similar thing with the Case-Shiller Home Price Index. That reversed 5 months of declines, up 0.2. Year over year, it's up 1.6%. If you take out kind of the COVID distortions there, that goes all the way back to July of 2012 as well. So the price increases are, again, moderating. And this thing's also up 51% from pandemic levels. I think the point here is, again, if these prices start to moderate and you get a continued kind of come down in the mortgage rates, there is demand waiting. But the problem is just prices are just absolutely too high right now, and people can't afford it. On the confidence index, that ticked down to 94.6. September was upwardly revised, but that's the 3rd down month in a row. Present situation index ticked up while expectations moved lower. These have been kind of trending lower overall of late as inflation expectations have kind of bottomed out and started to maybe move back up a little bit. But I think you see this in the Michigan index as well, where I think they feel like they're broken, but I think a part of it is just the higher inflation levels. People are still kind of anchored, for better or for worse, prior to pandemic increases. And then if you're out there trying to buy a home or move and you can't because things are so high, like that weighs on your confidence, regardless of your immediate financial situation. You just feel a little bit more bummed out because you're like, I'd love to upgrade and I can't, and I'm stuck where I am, and it's hard.
there's been a lot of kind of research on how inflation impacts sentiment or kind of the way people feel disproportionately. Like it's a very negative effect on people's kind of
Mhm.
psyche, though the economic reality it's can be it's obviously bad, but it's not as bad as kind of the proportional psychological
Like,
effect.
I mean, you go back to eggs or bacon when those were hot ticket items, and it's like those are one item in the basket,
Yep.
and yet the fact that you wanna buy eggs, you buy your whole other grocery
Yep.
basket and everything's fine, but you go to buy eggs and
Yep.
they're twice as much as you
Yep.
thought, that craters your sentiment
Yep.
and overrides everything else in your basket
Yep.
regardless of what it did.
Exactly.
So it does weigh more heavily on your psyche than I think it feels like it should rationally.
Yep.
On the labor market differential from that conference board reading as well, that's jobs plentiful, less jobs hard to get. That ticked higher for just the second time this year, up at 9.4%. Jobs plentiful rose to 27.8, while those indicating that jobs are hard to get ticked up to 16.4. So that's, it's a tick up. I think this thing is still kind of moderating, but you
Hmm.
saw it's still well above the long-term median. But again, this thing clearly moves in big swings, as you can see
Yeah.
on that chart on the left.
I know that historically, this kind of jobs plentiful minus jobs hard to get, it's, looking at the survey of what people are responding, it does track the unemployment rate very closely over the kind of long term.
Hmm.
Kind of logically, if there's a lot of jobs out there, then the unemployment rate's going to be lower. If there's not many jobs out there, it's going to be higher. But this is an example that I bring up of a private data point not coming from the government that can be used as sort of a proxy
Hmm.
for government data that you're not getting because the government shut down. So there's stuff still out there like
Yeah.
this that you can kind of back into, okay, what does that imply for what the unemployment rate actually is, even though we can't see it. But yeah, it did improve slightly in September.
Yeah, and also on the right there, we talked about kind of the way one item or inflation in this case can
Hmm.
kind of override a lot of the other positive sentiment that you might have. That there's a case in point here is on the right, you have the foreign vacation intentions within 6 months. These are back up to 20.5%.
Yeah.
That's higher than it ever was pre-pandemic. It topped out at not even 15%. So the fact that the number of people are like, oh yeah, I might take a foreign vacation in the next 6 months, but I'm really sad.
Yeah.
Like those
Yeah.
are two things where you can see certain the way the survey is structured or
Hmm.
whatever it is, but there are certain things underlying that kind of actually show a little bit more of the reality
Hmm.
rather than the headline, oh, I'm bummed because I think inflation's going higher. It's like,
Yep.
well, if your financial situation were that dire, you probably wouldn't be
Yep.
planning a foreign vacation in the next 6 months.
Hmm.
So it's just worth kind of looking at multiple pieces on how
Yeah.
this is spelled out. I think the final couple data points we have here are the regional Fed surveys. These are kind of manufacturing indices, and they look at different regions and kind of onto the composite as a whole. They point to kind of a broader PMI reading, which we actually get this week. But basically, we have all the five Fed manufacturing surveys are out for October. Current activity indices were up everywhere except for Philadelphia, which saw a large decline. That kind of overshadowed almost everything else. But four of the five up is a good spot. And then on the future activity, three of the five were higher, and the simple average is at its highest since January. So it's buoyed by solid increases. And the regions that decrease were not huge
Hmm.
decreases. So kind of more positive than negative here. And that's kind of the data we've got this
Hmm.
week. I think to recap, as expected, the Fed cut by 25 bips. December is a little bit more muddled given the shutdown, lack of data, some dissension or dispersion within the voting members. Home price indices increased in August. This is a kind of a massively delayed thing, but that for the first time in a few months. But the year over year continued to moderate. Conference boards consumer confidence index ticked down, labor market differential and foreign vacation plans ticked up, and then the regional Fed survey is more positive negative. This week we are supposed to get, we will get the PMIs because
Hmm.
that's not government issued, but we're supposed to get the trade balance and jobs opening and labor turnover survey. Those are probably not coming out. Neither is Q1 productivity and unit labor costs or non-farm payrolls on
Hmm.
Friday. We do get ADP and job cut announcements. That's
Hmm.
Challenger Gray. Those are both private. And again, kind of piecing together a broader employment picture from these other independent private data sources. So that's kind of what we're continuing to do, as
Hmm.
well as the Fed and the street. But that's kind of the long and the short of it for this
Yep.
week. We thank you for joining us, and we'll talk to you guys next week. Take
Thank
care.
you.